All right, Mike's second question is related to, let's just go to the quotes page here, the stock research page. The second question is about price to book ratio. Why is it negative for a few stocks like PM? Is this a warning or a good value? Okay, so naturally the price to book ratio is, thought it was on the left-hand side, it's right in the middle there. Here's the book value. Okay, and we have our current price. I'm sorry, PM is up here at 78.80. We've got a book value of negative 770 per share. The price to book is negative 1024. All right. So the value stocks, what's considered a good price to book ratio. Less than 3 is considered okay. Less than 1 is considered a great value. What does negative typically mean? A negative price to book value could mean a few things. It could mean that there is a cash flow issue. You'd want to do further research and analysis, but it could also mean, in this case, that they've done a recent payoff of some kind where their assets and liabilities are now showing a negative value. And of course, just dividing by the negative value gives you this negative 1024. Okay. It doesn't always necessarily mean a bad thing. It could, like I said, it could be related to something recently that came through. They had a one-time payoff of something. They had a settlement of some kind, and cash sort of came out of their liabilities, which put their book value in a negative range. That might not mean it's an in trouble stock going forward necessarily. But if it's something else that's related to a cash flow problem, then you might want to look at that as well. Another thing you might want to consider, I didn't get a chance to do this before the webinar, is to look at, I forget their symbol. I can't remember if it's ALTR, so I'll just use a simple lookup, is to look at other companies in the same sort of sector and industry. ML, I always forget that. All right, so here's Philip Morris here. We've got it at negative value. Let's check to see what the price to book is on MO. Okay, and this one, 352 per share. So depending on if there was a one-time event, all right, if there was a sort of range on that factor, there was a one-time payout or something along those lines, that could explain the negative price to book. You want to research that, Mike, to see why that negative value is showing up in the book value. You should be able to find that very quickly on your broker, I believe. I don't think I have the correct data shown here for the calculation, all the factors that they use in the book value to show why it's negative. Your broker may have that. Look into it. See if you can quickly identify why the book value is negative. It's just related to, again, a one-time sort of payoff that in the future that's going to actually benefit the company, or if it's because of something that might be a bigger problem as well. The out-of-the-money options, actually, I'm talking about the out-of-the-money calls that worked for me with this recent market movement. I didn't pay into a lot of implied volatility because they were all for next week's expiration. They're all closed now for profits, but they're for next week's expirations, which are not going to be affected on the 3 stocks I did this on by earnings, by the election, but yes, still be affected by the pandemic. So an example, if I look at On wasn't really a good one, but GOOS was. Okay, I don't want the time skew. And I'll show this with Apple too. Here's what I mean. Where's all the volatility for most stocks? It's right in here. Why? Because the election is here. This stock probably has earnings here. I didn't look up Goose's earnings. I just knew it wasn't here. Okay, so that's what I did. I bought cheap calls here, expecting rises in the price, and they worked. Okay, but that's where the volatility is. Let's take a look now at Apple. I was doing this, finishing up the slides for the rest of that EEP presentation we shared a little bit of last week. And the second, we talked a little bit last week about that first call the customer asked about. Oh, this is a little different graph now. Yeah, that is the at-the-money strike. Let me see if it's different though. The screenshot I had was a little bit different. That's it. What I was looking at there, I know this is a little bit strange, but here is our Apple has earnings, I think, on around 10/27, 28, I believe. And this is that November 1st and 2nd expiration. And here is the December expiration. And everything's, of course, everything's lesser further out in time. But here is the 16th. I'm sorry, the first line was the 16th, and then the 23rd. They're pretty high volatility, but not at the peak. Why? Because these expirations are earnings and election. These expire before the earnings and the election. So I was actually focusing on the 16th and the 23rd expiration for the stocks that have earnings coming out the 27th, 28th, 29th, and then the election. And the pop-up in the market worked for me well. But I'm out of them now, and I'm not buying more new calls next cycle because now I'm getting into that range where anything that would give me a decent expiration is too high implied volatility, and that's going to get hurt. And there's going to be wild swings. There are going to be wild swings as well. All right. So I just wanted to mention that using the volatility skew and why what I said last week that, buying November calls, buying December calls is dangerous for the discussion we had. The first example, why can't I remember the stock? The first example, it was AMD. Customer was looking at the 85 call on AMD for November expiration, 40 days out in time, was a price of $8, 9.7% extrinsic value. Huge. And it's because the November 20th expiration for AMD is going to be affected by its earnings on October 28th or 27th, going to be affected by the election on November 3rd, the election results, I should say, on November 3rd, and still the issues surrounding the pandemic that are going on. It's a lot of time value. The other one was the Apple 115 call for December expiration. Higher price than AMD. AMD was at 84.86. The 85 call was slightly out of the money. It was at the money, so that's why the time value was high, but it was also inflated. But the Apple 115 on that same day we talked about was October 1st when I had those two coaching sessions. This was also at about it was 8.7% time value. It was extrinsic at that time, all time value, I believe. And looking at how those options fare, they're actually both losing money right now because the stocks have stayed right around there and volatility has moved up and down, but mostly down. But it still has a lot of fluctuation to go. The earnings come out and each stock only moves 2%. That implied volatility is going to be cut down. Then the election and after the election, even if the market does pull back after the election based on the results, declines harder or everyone overreacts the first or second day after the election, what's going to happen? The implied volatility is done, right? That known event with an unknown outcome is done. Even if the market's falling, the implied volatilities will likely ease off a little bit because now the result of the known event with an unknown result is now known as well. Okay? And hopefully this is what I do want to see for calendar spreads. And someone had just commented on that and said, it looks like it's a great time for calendar spreads on Apple. Well, yes and no. Just like with the short strangle, what's the idea of a calendar spread? Well, I'm going to sell a short-term option call or put and buy a farther out option call or put. So I might end up with a calendar call spread or a calendar put spread, profit and loss chart, or combine them both into a double diagonal because I'm selling into near-term implied volatility and I'm buying out into low, well, not 22. We might be going out here we're buying into lower volatility and selling into higher. You're right. But what have I created? Just like the short strangle, we're in a neutral position. What do we know is going to happen? Stocks are going to be fluctuating to this point. This is like November 20th at the height of implied volatility here. Why? Because again, that's going to be the expiration most affected by the results of the election and earnings season going through. And the stocks and everything are going to be going wild. We're going to be going above and below those short option strike prices, requiring a lot of management. Am I doing the structure correctly? Yeah, I'm selling into high implied volatility, theoretically, which is what I want for my two wings, like the short strangle that we talked about at the beginning from William H. And I'm buying into lower implied volatility to complete that calendar call or calendar put, or what's called a double diagonal if you combine them together, give you that sort of profit and loss chart. But we know the market's going to be fluctuating a lot due to these upcoming events, known events, unknown results. And I've set myself in a structure where I'm neutral. So in theory, I'm doing everything right with the options. But in sentiment, I'm sort of trading against myself because this is unlikely to be neutral market condition in that case in the next couple of weeks. Satish's question. He says, Mike, can you talk briefly about the strike of paid tool and how do we use it? Okay, so one thing you might want to check out later, Satish, if you have not, just very quickly. I'll go over it, but very quickly. Am I showing my screen? Oh, yes, I am. Okay. Power options tools. So I'm in the webinars again. Power options tools, market sentiment, historical, portfolio tools. I didn't think it was that. I thought I mentioned here signature tools to improve your trading. Talk about initial introduction to the market sentiment tool, stock insurance tool, spread chain. Maybe I didn't get to it there. I think there's another webinar where I also discussed this. I'll find that for you, Satish, related to the strike of pain. But hey, this will be a good a topic as any, or good as presentation as that one anyway. Strike of pain tool. All right, this is one of the signature tools. This is based, and same thing, similar to what's called the max pain equation that was developed by BCA software almost 25 years ago. Could have been more than that. The max pain theory is much older than that. It was really developed in the 80s. And what investors, floor traders, started to notice around, I guess, mid 80s or so, maybe early 80s, is that on expiration day, when we only had monthly expirations, and probably, I don't even know at this point, maybe only 200 stocks, maybe only 300 stocks offered options. I'm not really clear on that. The records aren't really clear on that, but I can't imagine it was anywhere near the numbers we have today. For optionable stocks. There was no weeklies, right? There's nothing like that. Everything just expired third Friday, or if it was an index, Thursday at 3 p.m. or whatever it was. Okay, anyway. What the floor traders noticed is that many stocks had a tendency to sort of be pushed or to gravitate towards this particular price on that third Friday. That it would seem like something was moving it towards this exact price, $35.05, pushing from $34 up to $35.10. $70 stock suddenly pushed up to $72.50, even though it was down the day before, or there was no other news on the stock. It sort of moved up or it came down. And the concept was, what was developed is this idea of the max pain equation. What the max pain shows us, I'm just going to go out a little bit here. Let's go out to the 23rd, which I think is 2 weeks out, not affected by the earnings on Apple. The idea here is that this value here, what is it doing? It's calculating what's called the pain value based on the open interest for the in-the-money calls and the in-the-money puts. What do I mean by that? If Apple ends at 110 on the 23rd, the 111 put, the 112 put, 113, 114, 115, 116, so on and so forth, puts will be in the money. So that intrinsic value times the open interest, the intrinsic value at each price. So, at 113, we took the intrinsic value of the 114 in the open interest plus the 115 in its open interest, so on and so forth. Well, $2 for the 115, $1 for the 114, $3 for the 116. At 110, this is taking those values, but if the 113 is at $3 times its open interest, the 114 would be $4 intrinsic times its open interest, the 115 would be at $5, and so on, all the way up the line. And then the calls. The 108 call would be 2 points in the money. The 107 would be 3 points in the money times the open interest. And then you get the total intrinsic combination times the open interest at that intrinsic combination gives you a number. And the lowest number is called the max pain value. We call it the strike of pain because we have permission to use this from BCA software. They just said, we don't want you using the name max pain, create another name. We call it the strike of pain. This price that's highlighted here for an expiration date that you select on the stock that you select, let me clear that up, is essentially what? Well, this is the lowest pain value, the lowest value, strike of pain value. This is where option buyers will lose the most money based on the current open interest and the value of intrinsic. The option buyers will lose the most, and the option sellers will technically win the most. And the theory is that this is the price that is believed the stock will gravitate towards coming up to the 23rd expiration. Years ago, before weeklies, before single strike options, I did a variety of tests. A gentleman named Mike Phillips, who co-wrote the Iron Condor book with Ernie Renner, who is no longer working with PowerOptions, he did a study on this as well. And we don't have the history on this. We don't track the history on this. It's not part of the historical database. We did it manually, meaning for a course of 4 to 5 months, we were looking at the strike of pain for a grouping of stocks, 5 to 10 stocks, of course, and seeing how it changed day by day, but also seeing how accurate was it. And the trick is that we only saw accuracy on the strike of pain tool to the tune of, I think it was something like 55%, which isn't bad. But the concept, if I remember correctly, he had most of the research. I helped him with it. I did my own too. But this was about right. It's about 55% accurate, meaning that 55% of the time, the stock was within 1 or 2% of where its strike of pain was 7 to 10 to 14 days before. Well, as options traders, with trying to use weekly options, trying to use this tool as a trading tool, trying to use it with weekly options, and trying to use it for single strike options, 55% of the time, 1 to 2% is not good enough, is it? I could say, yeah, well, okay, so I think the stock's going to end at 110. What's the best strategy I could do? Oh, I could sell a 110 long straddle position, and even if it's off by 1 or 2%, I should still make money, sure. But if it's one of those other 40% of the time, it's off by 4 or 5% because, something might come out between now and then, I'm at a huge loss. Okay, this is sort of designed as a pinning tool. I just was never confident that these numbers weren't too bad. When you had 5-point strikes, when all we were talking about is a 55 strike, a 52.5 even, and then a 50. Even in a $30 stock, you had a 30, a 32.5, okay, and maybe a 35. You didn't have a 30, a 31, a 32. You didn't have a 30, a 30.50, a 31, and a 31.50, because that 1 or 2% on those types of strike differences, dollar strikes, 50-cent strikes, can really add up fast. But that's the concept of the strike of pain tool. What is this not taking into account? This is really tricky. I selected October 23rd for a reason, Satish. Why? Because what do we know about weekly options? We know that most activity, a lot of activity that happened yesterday and today might have been people moving the October 9th expiration to the next weekly series of October 16th, whether they're in spreads, whether they're selling naked puts, whether they're doing covered calls weekly basis, whether they're doing that activity. They must have moved 1 week out. And come the 14th or the 15th, or even on the 16th, they're going to move the 16th out to 10/23rd. Why am I bringing that up? Because the one thing we noticed in the old days when we did this testing is that 55, 58% I mentioned being right, meaning the stock was in 1 or 2% of its strike of pain value when we did those testings there. What we also noticed is options that were 3 or 4 months out were much less reliable. They were probably only right 35% of the time. Why? Because the open interest that's used in the equation hadn't been put into those options yet. This is when we just had the monthlies. So we were looking at in October. We started tracking the October, say in September, and we saw, some of the values of how correct it looked as you got closer to expiration. The closer you are to expiration is important. It seems to work better the closer you are to expiration. That makes a lot of sense because the open interest is accounted for almost fully. But in the case of a weekly series, me looking out right now on October 23rd expiration, when I know that the open interest for all these options is probably going to increase, I'd say as much as 40%, maybe more, as we go into next week and get closer to the 23rd expiration. That open interest is only going to go up. What could the open interest do? It could move it to 115. Okay, let's say Apple, for some reason, gaps up 4 or 5 points and goes to 121 sometime next week. Well, the open interest of these options is going to increase faster than these deeper in the money, deeper out of the money options, most likely. There's no at the money series. They're just going to start to go up. So that's going to move the line, isn't it? That's going to start moving the line. This is a snapshot of what is here now, Satish. We know that as we get closer to that expiration, those open interests are going to start increasing. As we get closer to next week's expiration, the open interest for the 1023s are going to increase. That's why it sounds obvious when I say it, but as you get closer to expiration, this number becomes more valid. Well, yeah, because all the open interest is accounted for, and people are going to start moving out of these into the next cycle. But it's dangerous to try to do it too far out in time. And with the weeklies, I'd say this 2 weeks out is almost too far, because I'm estimating that the total open interest for Apple for this expiration across all the different strikes here, this total open interest, I have a feeling that that's going to go up 20, 30, 40% into the middle and end of next week, because people are going to be moving their 16th expirations into the 23rd. Okay, so that's the strike of pain. That's the idea. This one highlighted for you. We do the math for you. Right now, this is the strike of pain for the October 23rd expiration for Apple. That is going to change as we get closer to this expiration date, or if there's a significant movement in the stock price where new at-the-money options will start to be traded more frequently, those open interests will increase and it'll move the bar up for the strike of pain. All right. So that's our little strike of pain tool underneath the signature tools. If I have time in the next month or so, I'll try to get another experimental or actual sort of study put together with a bucket of 10 of the bellwether stocks, of course, across the market, and see if our numbers that we saw from several years ago still seem to have about that same transition there, that same percentage that I'm mentioning. Oh, question comes in, if it's not that accurate, why are you using it as a tool in PowerOptions? Well, one of the other great things about PowerOptions, let me just move this over. My apologies. One of the great things about PowerOptions is that when a customer gives us a suggestion, gives us feedback, gives us an idea of a new tool, gives us an idea of a new criteria they'd like to see, we actually research and analyze it and see if it, send out feelers, send out maybe a couple poll emails or survey emails to see if it would be, other subscribers, feel it would be useful. This tool is there because about 8 years ago, 9 years ago, a customer said he really likes this tool and he looks at it for his 3 or 4 stocks, 8 stocks that he tracks on a regular basis, and he felt it's really, really strong for him and for the stocks that he was tracking. So we figured out how we could do it. We figured out what we could put in there, and we did it. And that's why it's there. It's not something that we necessarily use ourselves. There are many investors who do sort of use that, Satish. I'm just giving you what I've seen with mine. Sometimes it's been dead on and beat my expectations. I mean, a couple years ago, there was one I was looking at. I think it was CarMax, to tell you the truth. And I can't remember the price, but I was in CarMax, I believe, as a married put. And I thought to myself, there's no way that this stock's going to move up 8 points in the next 8 days. It was a $50 stock, maybe 45. I can't remember. And the strike of pain was showing me 53. I said, there's no way it's doing that. It was 8 to 10 days. Sure enough, and there was no news about it, and it wasn't near earnings. It did start to gravitate up, and it went to 52.5. I was very happy because I was in a married put, but it was pretty damn accurate in that case. But that's not every stock. That's not every time in that case. All right, so there we go with that. Now, I got about covers it. We're at 6:04 p.m. Eastern Time. I want to remind everyone, if you think of any other questions about today's material or other questions that you wanted to ask today, but maybe didn't get a chance to, I don't see any more questions in the queue there. Just send me an email at any time, support@powerop.com, support@radioactivetrading.com. You can also call us during market hours at 302-992-7971. And remember, of course, trial members and subscribers, you can get a free coaching session at any time. When you're logged on underneath the main home tab, just click on free coaching. You can schedule a time again to talk with myself or Ernie. Ladies and gentlemen, thank you for spending your time with me this Friday evening. I hope you all got some useful information out of today's presentation. I'll try to get these webinars put together for you soon. It looks like that first discussion we had from Mike, with the first question about the market sentiment, and then that led to his second question. But then with William's question, I'm going to lump those two together. So that first segment might be as much as, it seems like 25, 30 minutes, which is fine. But we're going to put all of those ones about the market sentiment together as much as possible, while still keeping it as a digestible presentation. And then we'll get the other ones out for you as well as some additional content we've been working on this week. So, ladies and gentlemen, take care. Stay healthy, stay safe. Have a great weekend. Have a safe and relaxing weekend. We look forward to seeing you sometime next week, and happy trading. Good night.